Good afternoon and welcome to another Australian Shareholders Association webinar. My name's Lee Gant. I'm the Chief Marketing and Education Officer at the ASA, and today I'm delighted to be joined by Tamim Asset Management Portfolio Manager Ron Shamgar. Ron's here to talk about Australian equities. He's got a special interest in small cap income equities, and also has a lot of special situations where mergers and takeovers benefit his portfolio greatly. He's here to run through a few of those types of companies and, of course, answer any questions you may have towards the end of the presentation. Before we get started, I just want to go through a little bit of housekeeping. If you do have questions for Ron, we'll be able to get to those towards the end of the presentation. Use your control panel to type your questions into the questions tab, and I'll pop on at the end and help Ron with those questions. Of course, today is about information education, not about financial advice. Please don't take anything that is said as advice. If you are interested in the stocks, you can get in touch with Tamim or another professional to help you with your personal situation. So with that out of the way, it's my pleasure to welcome Ron. Ron, thanks for joining us today.
Thank you, Lee, and good afternoon to everyone that's joined the webinar today. My name is Ron Shamgar, and I'm the head of Australian equity strategy at Tamim Asset Management. As Lee mentioned, this is just a quick disclaimer. Anything that we discuss today and the stocks that I will discuss, none of it is financial advice, and so just keep that in mind. As we move on, just a really brief background on Tamim Asset Management. Sorry. We provide investors several platforms. We have exposure to equities, both Australian equities. I manage the Australian All Cap Fund and the Small Cap Income Fund. We also have a global equities funds, and then we also provide investors with property exposure and fixed income. So today we'll speak about a little bit of our sort of broader macro views, sort of why we think this is a really good time to be invested in the markets, why we think sentiment is still relatively bearish, small caps. And then we'll delve into particular individual stocks, which is the more interesting part of the webinar, in my opinion. So firstly, we always keep saying be greedy when everyone is still bearish, and obviously after 2022, which was a very nasty bear market year, this year we've seen some recovery. But when we talk to investors and you talk to fund managers out there, sentiment is still really relatively bearish at the moment. And there's a couple of charts here that illustrate this. This is the Bank of America Global Fund Managers Survey from July, August, and it illustrates the cash positions and where sentiment lies. And the fund managers surveys shows that investor sentiment levels of pessimism are at multi-year lows. If you look at the chart on the left, you can see that as of August, it sort of shows that the sentiment is still relatively low compared to some of the GFC, COVID sell-offs and so on. So there's still a lot of bears and negative sentiment out there. And then if you look at the right, this shows where are the most crowded trades at the moment, and it shows that cash is the most crowded trade at the moment. So investors and fund managers are sitting mostly in cash, and equities is still there's still a quite negative view of equities. So keep in mind that record cash levels means future buying power when sentiment does change, and it always does. And also keep in mind that we need bulls for a bull market, and we still don't have enough bulls out there. So this is all positive in our opinion as a buying opportunity. Next, we always like to put the sort of doom and gloom in perspective, and I really like this chart on the left, which basically shows bear markets compared to bull markets over the last 70 years. And it's really important to just give a perspective, a visual perspective, that bear market, which is defined by a drawdown of 20% or more, usually lasts for about 15 months at a time over the last 70 years. And in contrast to that, as you can see, bull markets tend to last for many, many years. You know, if you look at the 2022 bear market, which isn't on this chart, that probably most likely ended about 6 months ago, and it probably lasted for about sort of 15, 17 months, which is sort of the average. Now, history does suggest that we are closer or into the beginning of a new bull market, but obviously no one rings the bell to tell you that, and you can only really know that for sure probably 2 years down the track. So we think that it's really important to remain invested, because history shows that missing the first 10 days after the lows of the bear market reduces your returns by almost 20% 1 year later. Now, one more important aspect to think of is this chart on the right, which is the VIX, or the volatility index. And basically, the volatility index shows investors sort of sentiment on the risks that are out there. And usually when that index is trading at sort of around that 30 level mark or higher, it means there's a lot of volatility in the market. That means that investors are extremely concerned about all kinds of risks on the horizon. And we saw that elevated in 2022. Obviously, we saw that elevated in 2020 and so on. Now, the VIX, as of now, it actually shows on that chart, it says 17, but it's actually much lower. It's down to about 13 or 14 at the moment, which is a really good level. It shows that investors out there are, how I would describe it, as relaxed about the possible risks. So, you know, possible recessions and inflation, and rising interest rates, that's already all known to investors. So those risks are not as they were maybe a year or 2 years ago for investors. And this is when conditions are normalized, and this is when, you know, stock pickers such as ourselves can perform really well, which we have this year, because the focus comes back to fundamentals rather than sentiment, which is really good. And, you know, finally, we think that small caps have never been cheaper. If you look at the chart on the left, you know, the Aussie 200 index is basically trading on a 12 months forward PE multiple of about 14.5 times. That's sort of, you know, it's very, very long-term average, but over the last 5 years, its average has been 16.5 times. So it's currently trading at a sort of 15% discount to what it has traded over the last 5 or so years. Now, small companies are even cheaper. Small Ordinaries Index is trading on a 12 months forward PE multiple of 13 times. More interesting is that the small company sector is trading well below its long-term PE average versus large companies. You know, and as you can see on the chart on the right, there's a big discrepancy between the small odds and the ASX 100, and usually the small cap index trades at a premium, and right now it's trading at a discount to its larger peers. Now, if you believe like us that small caps have a greater potential for growth than their more established large cap peers, then there is an opportunity for small companies to outperform as risk capital returns to the sector, as the sentiment shifts. And it will shift because it always does over the next 6, 12, 18 months. And so we think it's a really good buying opportunity. So before we delve into the companies that we like to talk about, you know, what do we look for in a company before we invest in a business? So we're looking for certain characteristics in our target companies. The first one is we like industry leaders. You know, it doesn't have to be the biggest company or the largest market share, but definitely has to have a industry leading position, or a disruptor. So there are some industries that are being disrupted. For example, you look at the payments industry and the payment terminal market. You know, that's sort of dominated by the large banks. There hasn't been much innovation, and you have disruptors such as SmartPay, for example, which we'll discuss, that's disrupting and taking share. So we like those kind of businesses. We do like founder-led businesses. So we like the management or the board that has a large shareholding and they're aligned with the company interests, and more importantly, minority shareholders such as ourselves. We've seen too many times in the past, boards not acting in the best interest of shareholders for various reasons. So founder-led businesses tend to outperform over the years. We do look for profitable businesses. So we like companies that are growing their top line, their revenue, and more importantly, and especially in these times, we want profitable businesses because we think these are really important attributes. And companies that are generating cash flow, they tend to attract much better multiples and potential takeovers as well. A strong balance sheet is really important. We don't mind some debt, but we do like low debt levels. And a lot of the companies that we own have 10, 20, 30% of their market capitalization in net cash. And that gives you comfort, and it gives the board optionality as well to make acquisitions without raising equity and diluting shareholders. We do look for companies where there is a relatively low market expectation, and we basically, whether consensus expectations for that business is too low, or maybe the market is a little bit too bearish and the company is going to do a little bit better. We've seen some of these examples during this reporting season, and you can have really strong upwards share price movements when that happens. There are other attributes that we like as well. Obviously, industry consolidation can lead to takeovers. A new board or an existing board calling out for a strategic review in order to realize shareholder value usually leads to good outcomes for shareholders. And when we do try and identify near-term catalysts which are going to drive a re-rate of the share price, because at the end of the day, once we buy a business, we want the share price to go up. And if there are no clear catalysts for that, there's no point being in a stock and seeing it go sideways for the next 12, 24 months. Now, interestingly, when you take all these attributes and combine them, it does, and in many cases, has led to quite a lot of takeover offers in our portfolio. So over the last just under 5 years that I've been running the two funds, we've had 24 of our portfolio companies receiving takeover offers, which is quite significant. And that number has actually gone up. A week ago, we had a takeover for another company in the portfolio, Healthier, which was a 90% premium to the prevailing share price. And then yesterday, we had another takeover offer for another company called Cirrus Network at a 30% premium as well. So it just shows and kind of reinforces our view of what we've been saying. Small caps are significantly undervalued, and if investors are not going to value them adequately on the ASX, then we think private investors will take them off our hands into the private market. So we're expecting a lot more M&A to come. So now we'll start talking about some of the companies that we own. So the first one is a company called Symbio Group. It's roughly around a 200 mil market cap business. Now, Symbio is a leading T1 telco software provider. It provides services to large enterprises, government, small business. And it also has a phone number wholesale software business with customers, large technology customers such as Zoom and Uber. The best way to kind of describe that is when you order your Uber, for example, and you want to call the driver, or the driver is calling you, there's a number that appears on your phone. That number that is provided by Symbio. This Zoom call today or another Zoom call, you have an option to dial a number as well. If you wanted to dial into the conference call, that number again is provided by Symbio, and Symbio gets an annual fee for renting out that number. We like the business for various reasons. It's a founder-led business. The managing director owns 8.5%. There are a few other board members that combined own about 20% of the company. 75% of their gross margins are recurring, quite sticky revenue. They do have a strong balance sheet. So as I mentioned, no debt, and they have $35 million in net cash. So, close to 20% of the market cap. They do pay a dividend, and they generate good cash flow, which allows them to self-fund their growth and expand into, for example, over the last few years, they've spent quite a bit of money expanding into Asian countries such as Singapore, Malaysia, Taiwan, which hopefully will drive long-term growth. Now, again, all these things tend to lead to good outcomes, and they currently, they received, on the 1st of August, they received a takeover offer from another telco that's listed called Superloop, and that offer values Symbio at roughly $3 combined. It's a cash and scrip bid. The due diligence period is actually meant to end this week, and hopefully the board will recommend this offer, regardless whether the offer goes ahead or not, and we do hope that it does go ahead. We think Symbio trades at an attractive valuation, FY24 EV to EBITDA of roughly 5 times. We think it's worth $3 or more, and some of the catalysts, obviously, if this takeover doesn't go ahead, is an AGM update, further acquisitions, and starting to, turning profitable in their Asian expansion, especially in Singapore as well. So we'll have to see how that plays out. But again, our average entry price here is sub $2, and so obviously we've done quite well. The next one is a company called Viva Leisure. They're a $125 million market cap. They're one of the leading operators, owners of fitness clubs and gyms in Australia and New Zealand. They've got 346 locations. About half of those are company owned and the rest are franchised. Now, I think they are the second largest player in Australia. It is a founder-led business, which again is the kind of companies that we like. The managing director owns about a quarter of the company. Obviously, COVID, unfortunately for them, wasn't too good. But financial year 23 was finally a year that had no COVID interruptions, and they really were able to highlight the earnings power of the business. As you can see, some of those highlights on the right side. Revenue was up strongly, up 55%. EBITDA was up 4.5 times, and they're back on track to continue their growth. Obviously, as you can see from the bottom chart, COVID did impact them in FY21 and FY22, but that was out of their control. In FY23, they generated $12 million of free cash flow. We think that's going to grow to about $15 million in free cash flow in FY24. They got a really strong balance sheet to continue to fund growth, both greenfield, which is just opening more and more of these locations and clubs, and acquisitions as well, and they have been acquisitive in the past. We estimate they've got about $10 million of net corporate debt, so they have a good balance sheet with the free cash flow. We think they don't need to raise any money. The fitness gym industry is really a cottage style industry. There's 6,000 clubs, so it's ideal to consolidate. What we like about Viva, they're really tech focused in terms of how they run their businesses. They monitor each club every day. They have these dashboards which they can monitor, and if one of the clubs is underperforming, they can make changes, and they can really monitor that closely. Everything is self-serve. You can sign up on your mobile phone. You can come in and tap your phone to enter and exit the gym. You don't need any interaction with staff as well. They're launching Viva Pay as well, so that's basically when you pay for your gym membership, they're actually going to clip a ticket on that payment, so they're almost kind of becoming like a payments company as well. $15 per week is the average spend by their members. We think that's relatively non-discretionary, even in a sort of tougher economic time. We think their customers would rather cut back on going out or buying another pair of jeans compared to that healthy lifestyle of $15 per week of keeping your body in shape. Trading on an EV to EBITDA of 4 times, free cash flow multiple of less than 10 times. We think it's really cheap. And obviously the catalysts are when they give guidance for FY24, further acquisitions, and just a general re-rate of the stock as sentiment towards it improves. The next one is a company called Hello World Travel. Maybe some of you today have actually interacted with some of the agents. You know, everyone is traveling at the moment. $510 million is the market cap. It's a very attractive macro tailwinds industry at the moment. As you can see, there's strong demand from both local and international travel since COVID, and everything is reopened last year. You know, I just came back from overseas, Europe, and I can tell you everything is full. Everyone's traveling, flights are full, and things are looking good. We're just getting in the last you know 6 to 8 months, we're seeing a resumption of Chinese tourism as well, and more importantly, cruise sales, which Hello World is quite big in. It's again a founder-led business. The managing director owns 26% of the company, so this is a key. We think is very aligned with shareholders. They've been in a really strong upgrade cycle in FY23. They've upgraded their EBITDA guidance 3 times throughout the year, from 24 to $44 million. We're expecting a further upgrade in FY24. Now they have given guidance at the results for FY24 of roughly around $70 million of EBITDA. So again, another big leap in profitability. And they estimate that you know, the resumptions of travel will only go back to pre-COVID levels in FY25. As you can see on the chart on the bottom right, this is the total overseas arrivals and departures as of July this year, and it still hasn't come back to pre-COVID levels. So there's still upside there as well. Now, what we like about Hello World compared to, say, Flight Centre and the like, is that their average customer demographic, the average age is greater than 55 years. And we think that demographic is a lot more resilient to an economic downturn, as say the younger demographic that, you know, might have more sort of mortgages and are still sort of struggling financially. And I think also that demographic maybe were a little bit more worried to travel, you know, last year or earlier this year because of COVID and that, but I think that's really changing, and I think you'll see a lot more people in that age group traveling later this year and into next year as well. It's a highly profitable business. It also pays a good divi. I think it's about a 4% dividend yield. It's trading on an EV to EBITDA of roughly 5.5 times in FY24. Now it does have about $120 million of cash and investments on its balance sheet. So that's over 24% of the current market cap is in net cash. So that we think could lead to more capital management initiatives or acquisitions. They have been acquisitive, and we think they'll continue to do good acquisitions. You know, some of their peers like Flight Centre, Webjet, they're trading at much higher multiples than they are. So we think that over the next 12 months, the stock will get re-rated to what we think is a reasonable valuation, which is around $4.50 compared to about $3 at the moment. And the next company is, I mentioned it briefly before, but it's a company called SmartPay. So they're a $360 million market cap business. SmartPay is the second largest non-bank merchant terminal provider in Australia and New Zealand. And you know, if you know Tyro, or if you go into your local convenience store, a cafe, or even some of the Domino's pizza stores, you'll see a SmartPay terminal these days. Now they've got 15,000, a little bit more, 16,000 of these terminals in Australia, and they've got 31,000 terminals in New Zealand. Now in New Zealand, they have about roughly 20% market share. Now this is really important to understand. They run two different models in terms of their terminals. So in New Zealand, they have 20% of the market, 31,000 terminals, but they charge a flat monthly rental fee, so roughly $60 a month. And so they don't really make much upside. They generate about $15 million of revenue, and it's been a pretty static kind of business for years. Now in Australia, they run an acquiring model with another payments company called Cascal, and they actually, SmartPay gets to clip the ticket on every transaction, so that 1.5% merchant fee goes to them. They pay a little bit to Cascal and they keep the rest. So obviously, so they have 15,000 terminals, so half the fleet of New Zealand, but they generate over $60 million of revenue in Australia. So just to give you an idea of what's happening, which is really important, and I'll explain why soon. So just briefly, the company generates $5 billion of transactional volumes on their terminals, and we think they're on track to double that over the next 3 years. Now, FY23 was a real inflection point for the company. They've reached scale in Australia. They're generating free cash, which is able to fund their growth capex, and they're actually in a very small net cash position as well. They're a business that benefits from obviously tourism and the border reopening, which that's already happened. And on top of that, again, in sort of the tougher economic times, the average transaction value is $36, so low ticket value merchants, which is good, I think, when budgets are tight. The managing director has got skin in the game, which we like, and they are an inflation beneficiary as well, because as you can imagine, they clip a margin on transactions in Australia. So if there's inflation and the average price of items goes up, they just make more money. FY23 is a March end year, so they did $78 million of revenue, $18 million of EBITDA, and that should grow really strongly this year. Now, there is a significant thing that's happening at the moment, which the company has announced, and the New Zealand division is transitioning to an acquiring model the same way in Australia. Now, this is a game changer because, as I've explained before, they've got double the terminals in New Zealand, but they're making 20% of the revenue. So essentially, once they go through into this acquiring model in New Zealand, which will probably take 6 to 12 months to transition into, all they need to do is just convert their existing customer base into this model. If everyone converted to it, that's roughly a $120 million revenue opportunity, which we think 50% of that is incremental EBITDA margin. It does sound pretty good, but if we assume that only some of those merchants convert, then we think that this business by 2026 will be doing $250 million of revenue and $70 million of EBITDA, and a significant amount of that will be free cash. So compared to the current market cap, we think there's some huge upside here. It's pretty exciting. So we're looking for some updates on this New Zealand acquiring launch timetable, their quarterly updates, and this company had seen some corporate activity prior to COVID, and we think that could come back. The next one is a company called Fleet Partners. They're almost an 800 mil market cap business. This is a little bit of a play on the electric vehicle revolution and sort of transition that's happening out there. They're a leading provider of fleet management and novated lease services. They manage about $2 billion of assets under management. They're a big beneficiary, through some of these government subsidies for people to change to electric vehicles. And obviously electric vehicles cost a lot more, roughly 30% more than petrol engines. And so because of the way that they clip the ticket on the price of the car in their novated leasing and their asset management revenue model, they're going to make more money. They've got really strong business momentum. Their third quarter updates saw new business up 26%. And more importantly, electric vehicles represented 46% of all new inquiries and new business for novated lease. So that's really promising. Again, balance sheet has got net cash, no corporate debt. So we think they're going to do M&A, which will be very accretive. Again, a really attractive valuation, 9.5 times P multiple compared to some of their peers trading at 12 times or more. And what's interesting is that they've been doing a significant buyback program, which is driving strong earnings per share growth. And over the last sort of 18 months and into the next 6 months, they would buy 24% of their share capital. So instead of paying dividends, they don't have any franking credits. They're actually doing this buyback, which is probably one of the largest buybacks an ASX listed company has ever done, which is really good because even though they do benefit from elevated used car prices at the moment, and as those used car prices come down, they will make a little bit less profit, but more importantly, their earnings per share will continue to grow because of this buyback, which also provides really strong buying liquidity on the market. We think it's worth at least another 15-20%, and I think it's a potential takeover target. They will do an acquisitions, which will be really accretive, and we're looking for FY24 guidance as well. The next company is again another play on that EV thematic. So it's a company called IPD Group. They're almost a 400 mil market cap company. I think when they listed a couple of years ago, it was only 100 mil market cap. So they've done really well. They're an electrical wholesaler, and they also have an end-to-end electric vehicle charging solutions. They basically offer from consultancy to hardware to software to installing and commissioning electric vehicle chargers. It's a $5 billion market opportunity in Australia. As you can imagine, electric vehicle sales are really taking off. As of the first quarter of this calendar year, 7.4% of all new cars purchased were electric vehicles. And I think that number in July, August was already in the double digits. Now there's currently 5,000 public electric vehicle chargers in Australia. There's only about 500 fast chargers, but we are going to require at least 20 times more public chargers by 2030 compared to today. If you look at the Australian EV Council, they estimate that we need 1 million electric vehicles on the road by 2027 in order to reach that ambitious net zero emissions target by 2050. So that really equates to a 12 times increase from last year's level, or roughly 2.8 million chargers required. So, I think IPD is going to play into this thematic. It's profitable, it's dividend paying, and it's really the only direct EV thematic exposure in the ASX where you actually have a profitable dividend paying businesses. The rest are sort of speculative lithium miners and so on. So we really like this story. Again, it's a founder-led business. The management and the board, they own almost 40% of the company. We estimate FY24 net profit after tax of $21 million. They have roughly $20 million of net cash, so they can make some bolt-on acquisitions. It's trading at a reasonable multiple, maybe 17 times excluding cash PE, and we think for such a growth business that's a pretty good multiple. And so we're looking for FY24 guidance at their AGM and some strategic acquisitions potentially. The next one is a company called Clearview. So they're a $320 million market cap. And they're one of the leading and maybe one of the only sort of independent mid-tier life insurance providers that are left. The rest are pretty much owned by large sort of insurance conglomerates. They have approximately 4% market share of in-force premiums in Australia, but they're taking roughly more than 9% of new business share. So over time, as they continue to take more business share, their market share will sort of naturally increase towards that. If you think about the life insurance market, it's roughly a $10 billion market. We've seen a really improving industry fundamentals over the last couple of years. The market is back to growing again. In fact, the market grew by about 15% in the June quarter, which is really promising. And so with Clearview growing again, and they're very profitable, they're looking to take on more underwriting risk, which means that they can grow faster. They did recently simplify their business model. They divested all their wealth management and financial advice exposure. And so now they're a pure play life insurance company, and we think that will make them a more attractive takeover target as well. FY23 was a really good year. They've upgraded their profit, and they delivered $36 million of net profit after tax, so 41% growth. They have a super strong balance sheet. They have 71 cents in net assets, and the embedded value, including franking credits of essentially all their life insurance policies, is 91 cents. If they're trading at 54 cents, so as you can see, it's very significantly undervalued. They've paid a full year dividend of 3 cents, fully franked, so a really good dividend yield. And they're a beneficiary of rising interest rates, so every 1% rate rise adds more to their profit, as their investment float is obviously invested in government bonds and so on. The attractive valuations, they're roughly trading on a PE multiple of 10 times, but they're growing at 20% per annum. Now, this financial result under a new CEO, which we really like, they've given a sort of FY26 aspirational goals of new business market share growing 12 to 14%, gross premiums of $400 million, underlying NPAT margin, and so on. And so if you kind of like extrapolate that, and by the way, they're running well ahead of that, so we think they're going to hit those targets in FY25. But regardless, that kind of equates to 7 cents EPS, 4 cents fully franked dividends. So, with the share price where it is, we think as they show to the market they're executing on that goal, the shares will re-rate quite significantly. And finally, the last company for today is a company called Close the Loop Group. They're a $220 million market cap company. And again, they're sort of a play on that ESG thematic and waste recycling and the strong demand for companies to really look after their environmental footprint. So they're a global provider of waste recycling and packaging. They've built a really strong moat over the years, and they've established roughly 260,000 global collection points for various items to recycle and repackage, and actually make money. They have a revenue stream from these collections as well. There's a big demand from industries such as print, as you can imagine, print cartridges, printers, and so on. Makeup needs to be recycled. Supermarkets are looking to recycle their waste. Pet food packaging, the battery industry, the electronics industry, all those old laptops and phones and so on. So they, as you can see on the right, for example, they would take, commercial packaging, retail packaging, and so on, and it goes through some of their, internally developed processes. They recycle them and process them into these small pallets, and then they can make them into actual renewed products, such as, for example, they have a product called Toner Plus Road Asphalt, and that replaces traditional road asphalt, and it actually has a lot more longevity, and so it's a lot better to use and to drive on. They made a transformational acquisition. It was last year or early this year. It's called ISP Tech. They bought that in the US. And what ISP Tech does, they provide sort of a life cycle for refurbished products, especially in that electronics industry, so laptops and printers and so on. And so they get in these used electronics, they refurbish them, and then in many cases, so they sell them back into the market as well. So that business acquisition was transformative. It was over 100% earnings per share accretive, and that has enabled them to guide for FY24 of over 200 million of revenues, over $43 million of EBITDA, and $24 million of net profit after tax. Really good high cash flow conversion, and net debt is reasonable as well, and we think they'll pay that down over the next 12 months. They are a US focused business now after this deal. And so we think they'll also expand that offering into Europe, similar customer base. So there's a lot of upside here. They're trading on a FY24 valuation of, it says P of 10 times, but actually it's more like 9 times now with the share price slightly lower. EV/EBITDA of about 6 times. We think it's worth 50% more than the current share price. And some of the key catalysts is them sort of tightening up that guidance for FY24 and the progress on the ISP tech expansion into Europe and how they've integrated the acquisition. And again, we really like the management and the board. They own a significant amount of the company. And this is a really good business and a real beneficiary of the ESG economy. Now, finally, before we go into questions, this is just a snapshot of the 2 funds that I manage. It gives you an idea of sort of the returns that we've done. So if you look at the All Cap fund, that had really strong performance. Obviously, last year was a tough year, but as you can see, as of the end of August, the fund is back to generating those strong returns that we've been used to. It's up 25% net of fees. If you look at the last 5 years since I took over this fund, you know, it's annualizing over 15% per annum net of fees. And so I guess what we try to tell investors is that, you know, there will be some tough years like 2022 every once in a while, but over the long term, you know, we think we can do 15% or much better. And, you know, if we can do that for 10 years, you know, that's 4 times your money. So that's pretty attractive. And then the Small Cap Income Fund, again, performed relatively strong. Last year was down, but not as much as the All Cap Fund. This year, it hasn't recovered as the All Cap Fund has. But we think that a lot of the companies in the Small Cap Fund, they are dividend payers, and sort of their businesses that were, you know, weren't sold off as much last year. But we think when sentiment shifts back to small caps, as I've described before, we think that fund will perform really strongly. And so even that fund is still annualizing over 11% per annum after fees. So, you know, we still think that that's a pretty good return, but we think that return will improve significantly over the next 6 to 12 months. And if you have any questions, obviously, after this presentation, then, you know, feel free to contact any one of the Tamim people, staff, just to, if you want to ask more questions or you're interested to invest in one of our funds. Over to you, Lee.
Excellent. Thanks, Ron, and thanks for going deep into quite a few companies there and giving us a great optimistic view of markets looking forward. Of course, if you want to download Ron's presentation, you can go into the handouts tab, get your copy there. This presentation will also be on the webinar library on the ASA site, along with the handouts, so you can download there as well. They will be posted later today or early tomorrow morning. So we've got a few questions here. If you do have a question for Ron, pop it in the questions tab in your control panel, and we'll ask them to Ron. So first up, Linda's got a few questions here. We'll take it one at a time. First up, and this was more about you know, what you were describing at the very beginning of your presentation. Linda wants to know, why are some fund managers still sitting in cash if we are potentially at the start of a bull market? Shouldn't they be getting back in?
Yes, that is a good question. I guess, look, at the end of the day, you know, that is the sentiment out there, and I guess, you know, like I said, no one rings the bell, so to speak, when a bull market starts. You only really know it started, you know, a couple of years into a bull market, because then you can look back and realize when it did start. But history tells us that most likely it has started. And I guess what we're trying to tell investors is that sentiment is still bearish out there. So even though some investors think that the market has rebounded and things are looking expensive, we disagree. We think most of the rebound, especially in the US, has been led by just a handful of mega cap stocks. But the sort of small to mid cap part of the market, where we look for opportunities for opportunities in. That hasn't yet to rebound significantly. And because sentiment is still bearish, we think this is a great opportunity to invest in the sector. And that's why we think, if the sentiment was bullish and everyone, was in equities, and where's the opportunity? We're back to 2021 levels again. So that's why I think it's good to be a contrarian in this environment.
Very good. So, you're looking at quite a lot of small caps that their share prices are compressed at the moment. What's your philosophy or strategy for avoiding value traps?
Yeah. Look, at the end of, if you go back to that slide where I discussed what we look for in companies, you avoid value traps by looking for companies that are growing, are profitable, whether they're disrupting or whether they're a market leader. You're looking at businesses where you believe they're going to outperform market expectations. Now, once in a while you do get caught up in a value trap, and usually value traps are companies that they look cheap, they pay a really high dividend yield, and that's because the market is probably saying that that's not sustainable, and they're probably facing some headwinds, and that's usually tend to be a value trap. And so you need to really identify why these companies are trading so cheap, why they're on the low multiple, why their dividend yield is high. And unless you know something that the market doesn't, then usually it tends to be a value trap. In saying that, those companies do tend to get taken over if they stay at such relatively low valuations as well. So yeah, I guess if you focus on growing profitable companies, founder-led, you will most likely avoid value traps, but you can't avoid all of them, which is why we run a diversified portfolio of 30 stocks.
What if a company is already under a takeover bid? Do you have a view on, looking at it and thinking, well, perhaps there's more upside beyond the current bid if there's perhaps, another bid coming, or you think that the bid is too low? Is that something you do? Or if you see that a company is already under a takeover bid, perhaps that comes off the list of companies you're potentially going to buy?
Yeah, look, takeover is a very topical discussion at the moment. We've seen a lot of takeovers for our portfolios, and there's always, two sides to the discussion. The way we look at it is that if a board is recommending a takeover offer, and we believe that, at the end of the day, as much as we shareholders analyze companies and look at their financial reports and so on, the management and the board of the company, they know best. They know the company inside out. They're there every day. And so they really know what's going on compared to us, who get a few glimpses every few months into the business. So if they think there's not a lot more upside to go, and they're recommending a bid, then who are we as outside shareholders to disagree with them? And keep in mind that in our mind, most directors, board of directors, are actually conflicted to have their company being taken over, because if you can think about it, they get director fees, they sit on boards of listed companies, there's a lot of benefits that go with that. So unless they have significant shareholdings, and many of them don't actually own much in the companies they sit on the board of, they're not really incentivized to lose that annual income with the takeover. So if they're recommending a bid, then who are we to say no? Now, on top of that, and I always say that, look, if a company on the stock market is being taken over, and we think it's being taken over at a really cheap price, then everyone is going to know about it. And if it really is cheap, someone else will come in with a higher offer, and that usually occurs. And if no one else comes in with a higher offer, then the reality is the bid is fair and reasonable. And so, we think that we're happy to take it. In fact, we tend to disagree more with boards that reject takeover offers, because their idea of the company's valuation is maybe not based in reality.
Yeah, okay, that's interesting. I'm sure a lot of our members would be interested in that more activist approach around investing. Given our company monitoring and advocacy work, I'm sure some members and monitors would have a lot to say about board members not aligning with the rest of the shareholders, especially around takeover times. On takeovers, Ron, Greg wants to know how reliant you are on these takeover bids materializing in your portfolios. That is, how much of your fund's performance do you hope to be takeover driven? Do you have a percentage like 30, 50%, or is it something that is just materializing sub to your main investing practice?
Yeah, so look, we never hope for one of our companies to be taken over in order for us to perform. It's never a reason to buy a company just in the hope someone buys it. I guess the point that we're trying to make is that if you follow a set of rules of certain attributes and characteristics of companies that you look for, then over time, those type of attributes lead to takeovers, for various reasons, which we mentioned. If the company is disrupting, then the disruptors want to buy it. If it's growing, it's profitable, then it's obviously an attractive business to own. Usually if it's a founder-led or business or the board owns a large amount of it, they're always looking to crystallize value if the market is not willing to value them properly, and so on. So, following those fundamental approach over the last 5 years has led to a significant amount of the companies that we own being taken over, but it's not something we hope for. And it's like a benefit, it's like a bonus when it happens. But it has happened a lot. In fact, we do have a special situation takeover fund, which we actually launched and promoted it in May, a presentation which we did to the ASA in Sydney, and that's actually been really successful. So maybe we'll do something else in the future as well.
Sure. We've got a couple of questions around your investing philosophy and valuation. So we'll try and keep them general, because if we get too stuck into valuation models, we could probably go for another few hours. So first up, just in those items that you're looking at, you said there's characteristics of companies that you try to identify. Is return on invested capital one of those factors that you like to look at when assessing companies?
Yeah, definitely. So obviously there is a lot of metrics, financial metrics that we look at. I wasn't going to list all of them here. It's kind of pointless. But yeah, definitely companies, we look at things like return on equity, return on invested capital.
Ron just looks a bit frozen there, so we'll just give Ron a minute to read.
Yeah, can you hear me? I can hear you. Yep, can you hear me now? Okay.
Yep.
So
go on.
Yep. So I'll start again. So obviously we didn't list all the financial metrics that we look at just to complicate things, but return on invested capital, return on equity, definitely are things that we look at. Also margins are important. The gross margins of the business, the EBITDA and profit margin of the business as well. And you really want to break it down and look into the business, half on half, quarter on quarter, and so on. And you want to see a trend. Is this a trend of a business that's growing these metrics, or are these metrics deteriorating over times? And so obviously these are all important things which lead to the valuation of the business, and then what is the market going to rate it. So businesses that have these metrics on pretty high figures, they tend to attract higher valuations, higher multiples by investors compared to businesses that show sort of less attractive metrics in that regard. So definitely in terms of valuation, we like to sort of use several methods, whether it's peer comparisons, discounted cash flows, and so on. And sort of we take a blend of that. And the idea is is not to be sort of exactly wrong. It's better to be like pretty accurate, more not precisely wrong. With what I mean is that it doesn't matter if a business is worth $1 or $1.10. You're looking to buy it at 50 cents in the dollar, and so you have a large margin of safety. That's what I'm trying to say.
Yeah, yeah, cool. And so Bernard was asking, what is your valuation model? And you were just mentioning there's a couple of ways that you can look at companies. Do you want to quickly, just very, dot points, what do you mean by peer comparison? And then,
Yep.
for those that don't know what a discounted cash flow is, how do you think about what a company is going to be earning in the future and discounting it back to today? Just your dot points on how you think about it.
Yeah. So I mean, discounted cash flow is, as you mentioned, you basically, you're trying to forecast the company's future cash flows and discount it back to today. There's a lot of variables that can be put into that sort of valuation formula, which can give you quite different outcomes. So you're trying to be conservative. But I think also when I say peer comparison is that, you look at other companies in the sector, and then you look at their valuation. So what's their P multiples? What's their EV to EBITDA multiples? Or what's their, for example, sales multiple and whatever. And then, you take the average and then you compare it to the company that you want to invest in. And if that company is trading at a significant discount to the rest of the sector, then you know that there is room for upside if the market decides to re-rate this particular company compared to the rest of the sector. Now, there's always reasons why it's trading at a discount. Maybe it's a subscale business. Maybe no one really knows about it. It recently listed, or they had issues in the past. So you have to understand what's going on. But that's what I mean by peer comparison.
Yeah, yeah. Do you find that you are looking and sorting through companies first on the characteristics that you want to find in companies and then doing the valuation? So, or do you sometimes find that you come across a company that you understand the sector and go, oh, hang on, that is probably on a lower multiple, let's go and see if it's got the right characteristics. Is it chicken and egg, or what do you think comes first?
Yeah, I think it's a combination. I mean, obviously, I've been doing this for 20 years, and maybe I'm not showing my age, but I'm a lot older than I look. So you do tend to know most of the businesses that are listed on the stock market, and I guess over the years you kind of tend to know, the businesses, so you don't really need to understand the business from scratch every time. So you kind of you can see if a company seems to trade. Sometimes you see a company suddenly looking cheap. So it's more important to understand why is it cheap. What does the market know that you don't, or what's the market missing? Maybe the market's wrong. But then obviously, valuations always come last at the end of the day. You want to meet the management, which it's probably the most important thing, especially in that small to mid cap part of the market. You want to really talk to the company, talk to the management team, understand what the business is going through, where it's going, and then really try and make sure that they're sort of on the same track as you, and have, they're aligned with you, and there are people that you can back. And then once you sort of go through that, then you go through the financials, you try and estimate what the company can make over the next 2 years. And you look at all those metrics, and once you tick all the boxes, then you look, okay, what is it worth? And then if it's worth $1, well, what's it trading at? If it's 60, 70 cents, well, there's good upside and a margin of safety. If it's $1.20, well, it's kind of fully priced, so there's, maybe it's not enough margin of safety, and so on. So you really have to go through that process. But you can come in from both angles, so to speak, and sometimes you find opportunities because they look cheap, and then you delve deeper, and sometimes you're doing the work and then you go into the valuation at the end of the process.
Yeah, great. Thanks for sharing. Ron, quickly just ask this one last question. I know there's a couple more, and I'll give people a way of getting in touch and asking more questions. But just before we go, Peter's just interested, what's the minimum investment for your funds?
Yeah, it's a good question. So what I would say is maybe if you can see those contact details that we have there on the screen, you could contact Sid, Ben, or Darren, and probably better to discuss that with them. Different funds have sort of various minimum investment requirements. So yeah, I would suggest to Peter, maybe just give Darren a see call, and you can have a chat about it.
Yeah, absolutely, and that's a good recommendation. Of course, their contact details are there. Like I said, you can also download the handout in your control panel now, or grab it from the ASA website in the webinar library later when this presentation is uploaded to site. For those who want to get in touch with Ron as well, he's very active on social media. You can hit him up on LinkedIn or Twitter. Just find Ron on there. You'll see he's very open in discussing some of the portfolio companies and non-portfolio companies. So it's a good option to see how Ron invests quite regularly. Of course, we will be back in a couple of weeks with our next webinar. We've got a little bit of a break between drinks for now. If you want to see more presentations like this, please stay tuned to your email. And of course, we also have the Virtual Investor Summit coming up in October. There's heaps of great presentations coming up there soon. So check your emails, follow the links there. Ron, thanks so much for joining us today. It's been a pleasure and really interesting to look at some smaller companies and potential takeovers with you.
Thank you, Lee, and thank you for everyone that attended today. Much appreciated. Thank you very much. Enjoy the rest of your day.
Thanks, everyone. Have a great afternoon.